$230 billion. That is the estimated wealth of the Walton family today, more than the GDP of Portugal, more than the annual revenue of Walmart itself. 4 generations, 72 years, and an effective estate tax rate, according to economists who have studied the filings, somewhere in the low single digits. The statutory rate is 40%. The Waltons paid a fraction of that. In this case file, we are going to reverse engineer a single decision made by a discount store owner in Bentonville, Arkansas in 1953. A man nobody had heard of, a company worth almost nothing, a document signed on an unremarkable afternoon. And we are going to show you, step by step, how that single afternoon became the legal foundation for the largest generational wealth transfer in American retail history. The playbook has 3 moves. We call them gift, discount, dynasty. Sam Walton was not born rich. He grew up in rural Missouri during the Great Depression. His first store, a Ben Franklin franchise in Newport, Arkansas, failed when the landlord refused to renew the lease. His second attempt in Bentonville worked. By 1960, he had 15 stores. By 1970, 32. By 1972, the year Walmart went public on the New York Stock Exchange, the company was valued at around $40 million. Sam Walton's personal stake, substantial, but on paper, not yet extraordinary. What was already extraordinary, however, was what he had done in 1953, 19 years before the IPO, when almost nobody was watching. In 1953, Sam Walton had a problem that every successful American businessman eventually faces. He had built something that was growing in value, and the moment he died, the federal government was going to take a very large percentage of it. At the time, the top federal estate tax rate was 77%. 77. That meant that if he died holding his business directly, his heirs could be forced to sell most of it just to pay the tax bill. The business he had spent his life building could be dismantled by a single estate tax event. Sam Walton had no intention of letting that happen. Move 1. The gift. In 1953, Sam Walton transferred 80% of his business to his 4 children, Rob, Jim, Alice, and John. The children were minors. The business was called Walton Enterprises. Its value at the time of transfer, negligible. A few stores, a modest inventory, some leased retail space in a small Arkansas town. The entire company could have been valued in the hundreds of thousands of dollars. For gift tax purposes, maybe less. The annual gift tax exclusion in 1953 allowed a parent to transfer $3,000 per child per year without triggering gift tax. Over several years, with proper structuring, the transfers could be made at effectively 0 gift tax cost. The IRS blessed the arrangement. The children owned 80% of Walton Enterprises LP. On paper, the company was barely worth anything. On paper. Here is why the near-zero valuation at the time of transfer is the most important detail of the entire case file. When you give someone a gift, you pay gift tax on the value of the gift at the moment you give it, not on what it will be worth later. The IRS cannot come back 20 years later and say, that company you gifted for $300,000 is now worth $40 billion, so we want gift tax on $40 billion. The tax event was in 1953. The taxable value was in 1953. Everything that happened after 1953, every store opening, every IPO share appreciation, every decade of compounding, happened inside assets already owned by the children. The gain was never in Sam Walton's estate. It was never his to tax. The mechanics went further. The annual gift tax exclusion, the amount you can transfer to any individual per year without triggering gift tax, was $3,000 per person in 1953. Sam had 4 children. Helen, his wife, could also give. That's 8 exclusions per year, $24,000 per year tax-free per couple. Small amounts, yes, but stacked over 5, 10, 15 years, combined with the initial transfer of the partnership interest, they created a systematic and entirely legal erosion of Sam's taxable estate. Every year, a little more moved. Every year, the IRS got nothing. Walton Enterprises LP, the vehicle into which 80% of the family business had been transferred in 1953, did not stay a small partnership holding a few discount stores. It became the legal structure that held the family's interest in Walmart. As Walmart grew through the 1960s, as it expanded aggressively through the 1970s and 1980s, as it went public and split its stock and expanded internationally, the value of Walton Enterprises grew with it. The children's 80% stake grew from effectively nothing to tens of billions of dollars, all inside an entity that was already theirs. Sam Walton's taxable estate, meanwhile, reflected only his retained 20%, which was still enormous but was a fraction of the whole. The 80% was untouchable. Move 1, complete. Sam Walton transferred 80% of his family business to his children in 1953, when the business was worth almost nothing. He used the gift tax exclusion to transfer ownership legally and at minimal tax cost. The IRS accepted the structure. Everything that grew inside Walton Enterprises after 1953 was never in Sam's estate. It could never be estate taxed at his death. Move 1 is the foundation. But on its own, it is not sufficient, because there is still the question of what happens to the children's 80% stake when they die. Move 2, the discount. The family limited partnership that Walton created in 1953 did not just solve the gift tax problem at the time of transfer. It also created a permanent and ongoing mechanism to reduce the taxable value of the family's assets for estate and gift tax purposes. Here is how. When you own assets directly, stocks, real estate, cash, the IRS values them at full market value for estate tax purposes. If your Tesla shares are worth $1 billion, the IRS taxes your estate on $1 billion. But when you own a minority interest in a family limited partnership, a small percentage of a closed, illiquid entity that you do not control alone and that cannot be freely sold on the open market, the IRS does not value that interest at full market value. It applies a discount. There are 2 types of discount that apply to FLP interests. The first is the minority discount. Because a minority partner cannot force the partnership to sell its assets, cannot make decisions unilaterally, and does not control distributions, the IRS accepts that their interest is worth less than their pro rata share of the underlying assets. Typical minority discounts accepted by courts, 15 to 30%. The second is the lack of marketability discount. Because FLP interests cannot be freely sold on the open market, there is no stock exchange for Walton Enterprises LP. The IRS accepts a further discount. Typical marketability discounts, 15 to 25%. Combined, these 2 discounts can reduce the taxable value of an FLP interest by 30 to 40% below the underlying asset value. On $1 billion of assets, that is $300 to $400 million of value that disappears for estate tax purposes. Legally, the IRS has challenged FLP valuation discounts for decades. In case after case, the agency has argued that the discounts are artificial, that when a parent controls the partnership, the minority discount for the children is largely fictitious because the children cannot really be said to be at arm's length from the controlling partner. Courts have sometimes agreed. In cases like Strangai versus Commissioner, the IRS successfully disallowed discounts on deathbed transfers into FLPs. The courts have established that FLPs must have a legitimate business purpose beyond pure tax avoidance. The Walton structure had that business purpose, the orderly management and continuation of a family retail enterprise, and it was established decades before any estate planning was needed. Not on a deathbed, but in 1953 when Sam Walton was 35 years old and had decades ahead of him. By the time of Sam Walton's death in 1992, the family had built what estate planning attorneys describe as a constellation of entities. Walton Enterprises LP holding Walmart stock, multiple subsidiary partnerships, the Walton Family Holdings Trust, Walton Investments. Each entity designed for a specific purpose, operating the retail business, holding real estate, managing philanthropy, or simply holding assets in the most tax-efficient structure possible. Sam Walton died worth an estimated $8.6 billion, but most of the family's true wealth was already outside his estate, inside the Constellation, beyond the reach of the 40% estate tax. Move 2, in effect. The family limited partnership creates a permanent valuation discount on every dollar transferred between generations. Every inheritance event, every gift, every intergenerational transfer runs through the FLP structure and pays 30 to 40% less estate and gift tax than it would if the assets were held directly. Stack Move 1 and Move 2 together, and you have a system that acquires wealth at near zero cost and transfers it between generations at a steep discount. But there is still a third move, the one that makes the whole system permanent. Move 3. The Dynasty. A dynasty trust is a legal structure designed to hold assets not for one generation, but for multiple generations. In some states, in perpetuity. The assets placed inside the trust are no longer owned by any individual. They are owned by the trust itself. The trust pays no income tax on unrealized gains. It pays no estate tax when a beneficiary dies because the assets are not in the beneficiary's estate. They are in the trust. And in states like Delaware and South Dakota, where dynasty trust laws are most favorable, the trust can continue forever. Not for 20 years, not for 50, forever. Every generation of the Walton family can receive distributions from the trust, can benefit from its assets, can operate businesses through it, without the trust itself ever triggering an estate tax event. Here is what the Walton Dynasty Trust structure means in practice. When Rob Walton dies, his share of the family wealth does not pass through his estate and trigger estate tax. It was already inside the trust. His children, Sam's grandchildren, continue to benefit from the same assets without a taxable transfer event. When those grandchildren die, the same thing happens. The trust distributes to the next generation. No estate, no tax. The family's assets compound inside the trust, undisturbed by the IRS, generation after generation, producing distributions and income, funding the family's lifestyle, paying for philanthropy through the Walton Family Foundation, and growing, in theory, for as long as the family chooses to continue the structure. The Walton family today is estimated to be worth over $230 billion collectively. The 4 children, Rob, Jim, Alice, and John, plus their descendants hold what Forbes describes as the largest family fortune in American history. The Walmart stock they hold, the real estate ventures, the financial investments, the media properties. These all trace back through the entity Constellation to the original Walton Enterprises LP structure established in 1953. Economists who have studied the Walton family's estate planning, including researchers at the Center on Budget and Policy Priorities, have estimated that the family has paid an effective estate tax rate somewhere in the low single digits on its total wealth accumulation. On $230 billion, a 40% estate tax would have generated over $90 billion in federal revenue. The actual amount paid, a tiny fraction of that. So let us go back to 1953. Bentonville. Sam Walton is 35 years old. He has a handful of discount stores. He has 4 young children. He has a lawyer, a notary, a partnership agreement, and a vision of what the business might become. He signs the documents transferring 80% of Walton Enterprises to his children. The company is worth almost nothing. The document costs a few $100s to file. Nobody watches, nobody celebrates. The IRS takes note of nothing unusual. And with that unremarkable afternoon, Sam Walton sets in motion a chain of legal events that will protect, preserve, and compound $230 billion across 4 generations. without a single generation ever paying close to the statutory estate tax rate. Gift, discount, dynasty. It traces back to one signature. Here is what this case file teaches. Generational wealth is not inherited, it is engineered. The Walton family did not simply accumulate money and hope the next generation would manage it well. They built a legal architecture designed to outlast any individual, outlast any tax law change, outlast any market cycle. 3 moves. Gift the assets early when they are worth nothing. Discount the taxable value through entity structuring. Hold everything inside a trust that does not die when people die. The result is a fortune that compounds inside a legal vacuum, insulated from the 40% estate tax that would otherwise have the family's wealth every generation. This is not a loophole. It is the tax code operating exactly as Congress designed it, for people who own things, structured in entities, advised by attorneys who know the code chapter and verse. As always, a note before we close the file. The Walton family has operated within the law at every step. Their estate planning is sophisticated, aggressive, and entirely legal. The structures described in this video are available in principle to anyone with sufficient assets and the right professional advisors. Whether the tax code should be designed this way, whether the gift exclusion should be lower, whether FLP discounts should be curtailed, whether dynasty trusts should be time-limited, is a policy question for legislators and voters, not for this channel. What this channel does is show you the mechanics. The moral dimension, as always, is yours to determine. Both the outrage and the education are valid responses. Both are why dead money exists. Case file number 3 is already on the table. The subject, the offshore stack. How American billionaires use Cayman Islands holding companies, Luxembourg investment vehicles, and Delaware statutory trusts to create a second layer of legal protection beyond anything we covered in case files 1 and 2. The document trail runs through Panama, the British Virgin Islands, and private banking desks that most people will never see. If you want to be there when we open that file, subscribe now and turn on notifications. If this video taught you something you did not know, share it with one person who still thinks tax is a flat percentage and everyone pays the same rate. This has been Dead Money. Follow the money until it stops.